Welcome to the D-Risk Weekly Global Markets Brief. It is Saturday, June 27th, 2026. Last week, we watched global central banks deliver a hawkish reality check that rattled bond markets. This week, the narrative has violently shifted to our new theme of the week, the AI premium unwind. Across global exchanges, the euphoria surrounding artificial intelligence infrastructure is facing a severe reality check of its own. The biggest dislocation in macro markets right now is the stark disconnect between micro-level earnings and macro-level sentiment. We saw blowout earnings from semiconductor giants like Micron, yet the market aggressively sold the news. Why? Because rumors of an OpenAI IPO delay have thrown cold water on the entire timeline for AI monetization. Investors are suddenly questioning the massive capital expenditures required to sustain this tech build-out, triggering a rapid deleveraging event. As the data implies, we are witnessing a tactical rotation out of high-flying megacap technology and into defensive postures. The momentum trade is fracturing and the selling pressure is spilling across borders, leaving traditional safe havens scrambling for direction. Alex, let us start with the international picture, Asia and Europe.
Thanks, Sarah. The AI premium unwind is leaving a massive footprint across international equities, creating sharp regional divergences as capital flees the technology sector. Starting in Asia, the Nikkei 225 slid 2.65% on the week, closing at 69,361. The index was dragged down by a severe global correction in semiconductor shares, with heavyweights like SoftBank and Advantest suffering double-digit losses. Rising domestic inflation expectations are also fueling fears of further Bank of Japan rate hikes. Despite this pullback, the long-term structure remains bullish. The Golden Cross is fully intact, with the 50-day moving average at 64,085, sitting comfortably above the 200-day at 54,273. Over in China, the damage is much more structural. The Hang Seng Index plunged 5.24% to close at 22,672. The unwinding of highly leveraged AI bets across the region compounded ongoing mainland economic weakness, pushing major constituents like Alibaba to multi-month lows. The technical posture here is broken. A death cross is actively suppressing the market, as the 50-day moving average at 25,372 has crossed below the 200-day at 25,942. Moving to Europe, Germany's DAX slid 1.26% to close at 24,671. The German benchmark could not escape the global tech rout, and a specific overhang on defense giant Rheinmetall added to the downward pressure. The index retains its golden cross, with the 50-day at 24,604, leading the 200-day at 24,238, keeping the medium-term trend positive despite the near-term weakness. Finally, the UK's FTSE 100 rallied 1.40% to close at 10,508. The FTSE was the global outlier this week. Its value-oriented defensive mix completely shielded it from the technology sell-off, acting as a safe harbor for rotating capital. The index maintains a strong golden cross with the 50-day at 10,394, well above the 200-day at 10,054. Sarah, the international data shows exactly what happens when a crowded global momentum trade begins to unwind.
That defensive rotation in the FTSE compared to the tech-led selling in Asia perfectly illustrates the shifting tides, Alex. We are seeing a clear penalty for any index overexposed to the artificial intelligence narrative. But this brings us to the epicenter of the AI boom. If global markets are deleveraging their tech exposure, how is the United States handling this premium unwind? Is the U.S. following the same pattern of aggressive tech distribution? Or are we seeing a decoupling in the broader cross-asset space? Alex, break down the U.S. and cross-asset signals.
The U.S. is the epicenter of this AI premium unwind, Sarah. Let us look at U.S. equities. The Nasdaq 100 futures slid 1.20% this week, closing at 29,368. The S&P 500 futures drifted lower by 0.29% to close at 7,402. The market is demonstrating a classic sell the news reaction. Even with Micron delivering exceptional earnings, the rumored delay of the OpenAI IPO catalyzed a broad unwinding of the AI trade. Apple shares also dragged megacap technology lower, proving that valuation premiums are being strictly reevaluated across the board. In the plumbing, restrictive monetary conditions remain firmly in place. The 10-year Treasury yield closed the week at 4.40%. Bond markets are holding steady as investors digest benign core PCE inflation data against a backdrop of resilient economic growth. This higher-for-longer rate environment continues to support the currency. The U.S. dollar index edged up 0.51% to close at 101.36. The technical posture is firmly bullish with a golden cross. The 50-day moving average at 99.22 sits above the 200-day at 98.77, confirming sustained buying pressure as institutions upgrade their dollar outlooks. The most violent moves, however, occurred in the commodities complex. Crude oil plunged 9.62% to close at 69. The rapid de-escalation in the Middle East completely erased the geopolitical risk premium, sending prices to a 4-month low. Technically, oil presents a dangerous divergence. While a golden cross remains technically active, the price is broken significantly below both the 50-day moving average at 92 and the 200-day at 74. We must note this explicitly. A golden cross with price below both averages is a major breakdown condition, not a bullish signal. Gold suffered a similar fate, plunging 3.44% to close at $4,079. The precious metal is being crushed by the strong dollar and massive ETF outflows. The technical damage here is also critical. Gold technically retains a golden cross, but the price is broken significantly below the 50-day moving average at 4,488 and the 200-day at 4,448. This divergence confirms a severe structural breakdown as investors liquidate their safe haven positions in favor of yielding dollar assets. Finally, the VIX slid 2.54% to 18.41, signaling a modest reduction in immediate fear, though overall anxiety remains elevated. Sarah, back to you.
Thanks, Alex. That structural breakdown in both gold and crude oil, combined with the aggressive unwinding of the AI premium in equities, defines the week. When you see commodities collapsing through their long-term moving averages while the U.S. dollar maintains its structural strength, it implies a fundamental repricing of global growth expectations. The AI premium unwind is forcing capital out of crowded momentum trades and back into defensive, yielding assets. Looking ahead, the market faces a gauntlet of critical macroeconomic catalysts. Next week, traders will be hyper-focused on the U.S. non-farm payrolls report and the ISM manufacturing PMI to gauge the true health of the American economy. In Europe, multiple speeches from ECB President Lagarde and the preliminary Eurozone CPI data will dictate the next moves for the euro. If the labor market shows unexpected weakness, or if inflation data surprises to the upside, it could severely challenge the current higher-for-longer narrative and inject fresh volatility into this tech deleveraging cycle. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in, and catch you in the next episode.